welcome to the Investor Coaching Show. Paul Winkler talking about money and investing. Going solo tonight. All the way through. It wasn't exactly planned, but you know, that is what I'm used to. Good grief, I do it for 12 years. Totally by myself before letting anybody else get behind the mic. I'm a control freak, what can I say? Hope you're doing well. It's a great day to talk about investing and money because it's always a great, especially we've had kind of one of those weeks last week, which was a challenge for a lot of investors, and it is one of the reasons that investors tend to fail because challenging weeks can be challenging. If that's the most brilliant, it's like, as my son said this morning, Dad, that's as brilliant as saying water is wet. I know. What do you want from me? Okay, so investing information, what's going on in the world of investing, so that's what you're going to get. There's all kinds of talk about stock market bargains, and you may know kind of what I think about that, but I think there are a couple interesting points in an article by Jason Zweig this week that I would refer to. And 37-year-old self-made millionaire, don't retire early. You got to consider a few things if you're going to retire early. And I think that there are some points to be made that he made well in the article. There is a movement we call the FIRE movement. It's basically retiring early, saving your back end off, and then being able to retire early. And, there can be downsides, some of the things that you don't necessarily think about regarding that. And I think there are things for people that don't even retire early that they need to consider in that article. So I'll talk a little bit about that. So there's a lot of stuff today. Trying to decide where to start. One of the things that has been a theme many times here on the show, it just happens to be what's right in front of me, so I'll talk about it, is this whole idea of investing in alternative assets. We talk about, you hear commercials still, and I can't believe you're still hearing commercials about investing in gold. It just blows my mind that they're still out there, especially as there's news coming out that we're going to go to the bottom of the sea to actually mine for things. It just blows my mind. Did you hear about the battery? There was some kind of a battery. Now, I had Scott pull up something, and for the life of me, I can't find what he supposedly pulled up for me. But it was an article about a battery that somebody had actually, some kind of discovery regarding, and it has to do with BLTs or something like that. I don't even know what it is, sandwiching thing. I'm not even sure what it is. But this discovery would actually cause batteries to be a lot smaller. And I remember Scott saying something to me. He was reading the article, and he was talking about these little batteries, like, these little tiny ones that you put in your watch, those types of things. Well, not only would it improve that significantly, but it would also, Stuart, it would actually improve batteries that go into cars so much so that you could get it down to the size of a large textbook, which blows my mind. Yeah, because, the big problem, of course, with batteries and cars driven with battery power is doggone it, the price to replace those things. Somebody was talking about a car replacing the battery for $20,000. I talked to you about a couple of weeks ago, and I heard another one was $25,000 to replace the battery. Well, you got a new car. Are we going to have disposable cars? Kind of like when you get these landscape lights and they're solar power, right? And you just go, I just tell my wife, yeah, go ahead, get it for one season because that's all it's going to last. After one season, you're going to look out there and go, oh, doggone, we got to replace the battery. And then, of course, what happens is not only the battery is bad, but half of the connectors inside the doggone thing are no good either. So it's just disposable. And you might as well have disposable cars if you're going to pay that much for the battery. But this battery is a game changer, apparently. And, I've been talking about hydrogen forever and saying that would be the wave. And there's actually an interesting article about that I'll get to in a little bit about one of the major car companies and why they didn't go all battery. Very, very interesting. But anyway, so alternative investments, gold being one of them. You thought I'd never get back on track, right?
You're here.
I did it. I got it back. All right, man. am always impressed with how people will jump into things without really thinking about it and just put these investments in the portfolio based on short-term past performance. And this happened in 2008, 2009, that the big fund companies, the major fund companies would add these alternatives in their commodities, for example. And I've talked about before that the number one holding in Fidelity's target date funds, Target 2040 fund, was a commodity fund. After commodities had a run-up, then they added it, and then it had such bad performance going forward. Last time I looked, it was like number 19 in the lineup. It went way down as a holding in the portfolio. So it wasn't just minor investors or just amateur investors adding these things. It was a lot of big companies and big investment firms. And when we would do analysis of investment portfolios when they come to our office, we would see commodities, and alternatives. And you'd hear a lot of talk in the investment industry, financial planning industry, about commodities and alternatives. And I would say, no, this is not an investment, because an investment by definition has to have a cost of capital, which means that somebody has to be paying to use your money. Well, one of those more recent things that we've seen out there is Bitcoin, right? Cryptocurrencies. And Michael in the office up here, Michael Sharpnick, actually sent me something in an email, and it was from the Office of Crypto. And the email says the SEC has announced plans to add an Office of Crypto Assets and an Office of Industrial Applications and Services to the Division of Corporate Finance's assets. Assigning companies and filings to one office will enable the DRP to better focus its resources and expertise to address the unique and evolving blah, 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 blah. We're gonna now regulate this. And he said, you ought to check this out. And I says, my immediate response was this: now they want to regulate after people lost all of this money in Bitcoin. Bitcoin goes down from 65,000, over 65,000, to down less than 20,000. And all the time, even when it was a 65,000, I'm telling people, this is not something I would put in an investment portfolio. I said this many times on the show here. And then, of course, it goes down to less than a third of its, so at least less than a third. I mean, it just drops that significantly. And now we go, hey, let's have some regulation of this, shall we? After people lost 2/3 of their assets, some people that invested at that highest level anyway. And then you got this Forbes headline. I just noticed, I was looking around and I noticed this Forbes headline when I was actually grabbing data on the Bitcoin pricing. And it says, Joe Biden just sent a stark warning to Bitcoin and crypto after $2 trillion price crash. And again, when do they start to talk about protecting investors? After the problem has already occurred. And, there's a moral to this whole thing. And this is something I say over and over again. I've talked about it many times when it comes to annuities. I've talked to regulators about this. I've talked about some of the advertisements that you see out there on cryptocurrencies, and I see advertisements on gold, and I see advertisements on annuities. Specifically, it was annuities that I talked to the regulators about. But one of the things I said to them, I says, what gives here? So many of these claims that they have in these advertisements and these workshops that they're doing are so outlandish, and they're always talking about guarantees. And yet the reality is you have a guarantee only if you hold it for so long. If you have to get out, you need your money back, you can certainly get way less than what you put in because of the commissions and the fees and the expenses. And so what gives? And the comment was, well, we want to protect the consumer, Paul. We really do want to do that. And I get it. But the reality of it is, he said, it's one guy I talked to, he said, here's the reality. We want to let businesses run their businesses. We don't want to interfere. And, I totally see that. I am totally on board with the idea of letting America run as it does, and then eventually people will figure out if it's a bad deal. And unfortunately, in this particular case, it may not be until after they've lost their life savings is the problem that you run into. That's the problem you run into. If you look at, for example, people figured out that maybe the car wasn't so great, or maybe they figure out that there was a problem with maybe the stereo system didn't work so well, or maybe the computer wasn't the greatest, and maybe it had a touchpad that wasn't the greatest. A personal problem I have with my current computer. But it doesn't end the world. It's not the biggest deal in the world. But when you're dealing with somebody's life savings and they make a mistake because the regulators basically said the only thing that we can do is put it in print and put the warnings in print. And there's one huge investment firm. I mean, literally in just about every small town in America, this investment firm has an office. And I was talking to somebody the other day about this, and I says, says my sister has actually an investment portfolio with this company. And you said you're familiar with them. And I said, yeah, absolutely, I'm familiar. And I said, let me show you something. And he goes, oh, okay, what? So I said, let's go to their website. So we went to their website. And then we get to the website, we type it in, and I said, okay, now let's scroll down to the bottom, which nobody's going to do. And then I hit a button on there, and the button says something to the effect of, other information or something like that. And then what I did is I clicked on that button. Then I clicked on another button over there, and it's one of these ones you would not know to click on unless you were me and you knew what you were looking for. Then I clicked on that button. I scrolled down to the bottom of that, and then I clicked on another button. I'm not kidding you, Stuart. I clicked on 5 buttons at least on that website, and I had to know exactly where I was going to until I got to the part that described the revenue sharing arrangements that the company has, where if you buy a mutual fund from the investment advisor who works for the firm, that certain mutual fund companies share revenue with the main investment firm, and hence there's a conflict of interest. And they literally say it's a conflict of interest, but you have to dig so far down that you would never think of digging down that far. And then they have investment management portfolios, right? That they manage the portfolio and then we manage it for a fee. And you're thinking, oh, that makes them objective, right? They manage it for a fee. I'll never forget, a lady calls in one day and she says, hey, I got this investment portfolio. It's with such and such investment firm. And I said, let me just read the contract. Have you read the contract? Well, no, I didn't read the contract. I mean, why would I do that? And I said, you're right. Why would you? Who would do that except for me? And I read it, and literally the investment, the changes and the portfolio management were really left up to the investor, not the investment advisor in the contract. It was their responsibility in the fine print. And I'm thinking, what? Really? And they literally, every out that they could give themselves to get away from liability and any responsibility was all in the fine print. Now, it was there. You could read it, but you had no idea what you're really reading unless you knew the investment industry. And it just boggles the mind. So the moral really is this: the government, as much as they would love to protect you folks, they would love to do that. They are allowing companies to do what they do because it is America. We want that ability to have some freedom in this country. And it's just where we are. It's part of what's made America great. So it's kind of, I have this really conflicting belief on this and, feelings about all of this. So really what happens is the bad things they do with your money are completely legal. Now here's where the rubber meets the road. You can blindly trust the advisors. And a lot of times people don't know enough questions to ask. And hence that is the reason this show exists. I tell people over and over again, there are certain things I tell people to look at. Look at the buying and selling going on inside of investment portfolio. If you have a lot of trading, it can be a problem. I'll get into that more a little bit later in the show. But you can look at the style box. What area of the market the fund's investing in? Do you have several funds that are in the same area of the market? And that's another thing you can look at. But recognize that the investment industry it's regulated. There's all kinds of terminology that can be a little bit misleading. The whole fiduciary thing kind of bugs me a little bit. when I talk about that we're a fiduciary, that we have to keep best interest of the customer, but it's a really weak definition. And I think it ought to be a lot stronger. Maybe there ought to be levels of fiduciary. Like what I look at is, are we going by the books from academic research and the prudent investor rule? Can I open up the prudent investor rule and say I am following that? That would be fiduciary to me, but it's not really what the definition is. It's just it's buyer beware. It really is, to a great extent. As much as the government would love to protect you, they really can't. And that is why understanding a little bit of what am I doing, why am I doing it, how does it work, and what to expect is so important. And that is why so often I am getting back to those basics here on the show and really getting into how does a portfolio get to put together? What various areas of the market, and how do you know whether things are going okay? And, typically that is a process called benchmarking, for example. I look at large U.S. stocks. Do I own a fund that owns large U.S. stocks? Well, how's it doing versus that? Small U.S. stocks, how's that doing? So there are a lot of things to know, but you don't have to know everything, but knowing the right things are so, so important. And hence, that's what we'll talk about more today as the show goes on. I'll get into more education throughout the course of the show. Plus the news of the day, a lot of really interesting stuff. Some things that I've been talking about for years actually have shown up in the media in the course of this week. So I'm going to spend some time on that coming up just in a second. You're listening to the Investor Coaching Show. I'm Paul Winkler. Be back right after this. Stay tuned. All right, back here on the Investor Coaching Show, Paul Winkler talking about the world of money and investing. So many years ago, I talked about how companies would do things, and this shows you how people can be sucked into stuff in a heartbeat and pulled into something that's the latest fad. But there was Burton Malkiel, who was a Princeton professor, wrote the book Random Walk Down Wall Street, and he would just talk about how fads and fashions and how the stock market and people investing in the stock market, the history behind it is fascinating, and how this would actually affect investors and they would make mistakes. And he was talking about how easy it is to pull people off the wrong track, and went back through the 1960s, and he was talking about the tronics craze, and if you would just put he would just put a suffix behind the company's name, tronics, because electronics was the hot thing back then. Electronics that was in its infancy, and people were looking around going, man, I want to be on the cutting edge of everything. So you would have oscilloscope tronics, or, I don't know. It could be totally tissue tronics or something like that. It could be something that have nothing to do with electronics whatsoever. And if you put that on there, it would bump the stock price up. And then if you had anything to do with oil stocks in the 1970s, you could actually somehow affiliate yourself with the oil industry, and you get a bump in your price. And in the bond market, and then you get like biotech, for example, technology stocks, of course, is another one that comes to mind. But you would try to affiliate yourself with something that was hot in order to get a bump in your stock price. And the reason being is if you could get your stock price to go up, a lot of times with the government, they're trying to protect the end investor by not letting the CEO, again, this is another questionable thing, really, when it gets down to it, but not have the CEOs of companies earn too much money or earn obscene amounts of money. So what would happen is they would make sure that their pay somehow was commensurate with some of the production that they were doing or how they were adding value in the company. So hence, a lot of times CEOs of companies and people that work for companies are going to, the higher ups typically are going to get paid by that based on the stock price. If you can increase the stock price, then we have a material reason to pay you more. So you might have options, for example, and you can buy the stock for $20 and it's selling for a little bit less than that. But if it goes into the black and now it's, instead of $20 and it's, $30 or something like that, you bought it for a lot lower price and you can get a much bigger gain on it. You can magnify your gains. And there are all different types of stock options, and you can actually get all kinds of grants and things like that. But what would happen is that would incentivize the people in the company, the people that are higher ups that were making decisions for the company, to increase the stock price, because then they could get really, really wealthy and they could get a whole lot more pay and compensation. And it was tied directly to the performance of the company, because essentially what happens, the stock price goes up if earnings go up. And if earnings go, because you're buying the present value of all the future earnings of the company. So people are talking about it. Well, it makes them do short-term things. They mess around, they do things that will only short-term increase the stock price, and you can make a case for that. But the reality of it is the end investors aren't stupid. They're not going to fall for that. They're not going to fall for something that's only going to be short-run, and that's kind of a weak argument that they're doing everything for short-term gain. So what happens is that they would do, and then, this is the investor that happens to be fairly well informed. Let me put it that way. Now, there are a group of people out there that aren't terribly well informed and will push up a stock price for really, really silly reasons, apparently. And I thought it was kind of over. It didn't happen anymore. And somebody dug this up, and it was a $24 million. Now, this was a couple years old. And I hadn't seen anything like this in years. The last really good example I had was that electronics one from the 1960s that Burton Malkiel came up with. But apparently it's not a dead thing. You can get people pulled in on something that's absolutely ridiculous. And I guess meme stocks, now that I mention it, meme stocks are one of those things where you just go, what? They're paying how much for a theater company that people aren't going to see movies? They're paying how much for a company that sells games that people aren't really going out and renting the games there like they think? But anyway, so this was a tea company. And what they were doing, they said they were pivoting to blockchain. Just pivoting to it. And the stock jumps 200%. And like I said, this article is a few years old, because obviously what happened with Bitcoin is it ended up taking a huge hammering. But this article is funny. Long Island iced tea company adds blockchain to its name, and the stock soars. In a move that caused double takes on Wall Street trading floors and prompted comments on Twitter about how this must be the top of Bitcoin mania, a little-known microcap stock actually is now Long Blockchain Corp. And they changed the name to Long Blockchain Corp, and then bam, it goes up. And you look at this, and this is one of those, there's a couple lessons here. Number one, watch out for how easily you can be manipulated with individual stocks, number one. Now, this wasn't on a big, wide basis. This wasn't like the entire market being blown up by a name change or anything like this. This is just one single company. And it was a very small company, too, that was probably thinly traded. And what that means in English is that you don't have a lot of shares trading every day. And since you don't have a lot of shares trading every day, you can have just a little volume increase that increases the stock price significantly, number one. And that's really what happened in this particular case. But number two, it is, again, a single stock. This is a reason that you don't do single stocks. You can get really lucky, but you can get seriously unlucky. And you can get sucked into a story in a heartbeat when it comes to the stock market. And there are people, unfortunately, that will take advantage of naivety. And you just have to be super, super aware that this happens all the time. And it's not, these coins, these currencies, digital currencies, it wasn't just them, people that are investing in those things that actually ended up getting hurt. Now, some people made money on them. I know, I get it. There's some people that made money. There's some people, they still can't find their password to get their millions or billions or whatever they're worth. They can't even get them. So, and then there are people that are getting their money stolen from them because they're compromising the system. And they're getting in there and they're actually stealing, because it's basically a bunch of ones and zeros on a computer, and they're stealing people's information, and then they're going and stealing their Bitcoin, and they go from riches to rags in a heartbeat as a result. But, recognize that you can get pulled in pretty easily. And a lot of this really comes down to something that, I've been doing financial planning for, good grief, well over 30 years. And I remember in my early days, I would hear stories of people wealthy and people that were chasing after wealth. And it was one of those things that I would always kind of with a jaundiced eye, I would look at it. And people would pull me off and, hey, Paul, you need to go to this meeting. I'll never forget being pulled in on it. It ended up being a multi-level marketing meeting. And this guy wanted to get rich. And he says, I want you to check this investment out for me. I want you to check this thing out. And all the time he was trying to suck me in on his multi-level marketing. It was kind of, need to take a shower after going to one of those deals. But the thing that always impressed me is that when people try to get rich quickly, it's usually just a recipe for disaster. When you try to beat the system and try to get higher returns, and greed is not always good. I'm sorry, Gordon Gekko, that is not always good. If you ever watch Wall Street, you know what I'm talking about. And he does make some good points in that speech, though, because he talks about how in order to become wealthy, you have to serve other people's interests. And the problem is there are people that are out there trying to get wealthy without necessarily serving somebody's interests. You can produce a product or a service that's really great that everybody really needs and helps people and actually improves their lives. That's an okay way to get wealth because you're adding value in people's lives. When you're going after it and trying to beat the system with these types of things, it's a recipe for disaster. And just another example in this article of how that can happen very easily when we just chase after something thinking, I'm going to get rich with this individual stock. They're using blockchain for their iced tea, whatever that means.